Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about SHENZHEN Investment Limited annual report. SHENZHEN Investment Limited offers a diverse range of businesses and services through its 5 operational segments. At the core of its operations are property development and property investment, where it invests in and develops residential and commercial properties across mainland China. The company also engages in property management, overseeing the day-to-day operations of various properties to ensure their optimal performance. In addition to property-related activities, SHENZHEN Investment Limited has a significant presence in manufacturing, producing and selling industrial products to meet market demand. Furthermore, the company operates hotels and warehouses, providing essential infrastructure for businesses and travelers alike. It also engages in the sale of display panels and agricultural products, catering to specific industry needs. Moreover, SHENZHEN Investment Limited offers construction services, rounding out its comprehensive suite of offerings. SHENZHEN Investment Limited market capitalization of 6 billion is materially smaller than most of its industry peers of roughly 17 billion. SHENZHEN Investment Limited trades at a lower price-to-book ratio of 0.18 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 74% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has weakened over the past 5 years, accompanied by declining or negative operating income. This suggests the business may be eroding shareholder value and warrants caution. The share count has remained broadly unchanged, indicating no significant dilution or buyback activity over the past 5 years. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through a thorough analysis of various factors that contribute to an organization's financial performance. On one hand, revenue growth is primarily driven by significant increases in development sales, property development revenue, and rental income. The company has also experienced steady development of property contracted sales, sales breakthroughs on key projects, and accelerated destocking process through policy windows. Furthermore, improved project execution efficiency and enhanced product quality have contributed to the growth. On the other hand, revenue decline is primarily driven by impairment of inventories, associates, and joint ventures, which resulted in a significant loss of approximately $4.6 billion. Manufacturing revenue decreased by 6.3%, while revenue from contracts with customers recognized over time also declined by 34.6%. Additionally, intersegment revenue decrease and decline in rental income from lease arrangements with related parties have contributed to the decline. The company has also faced downward pressure on the property market and debt defaults by associates, which have further impacted its revenue. The net income of the company experienced a fluctuation in the past 2 years. Initially, it decreased by $4.365 billion from one loss to another, indicating a decline in profitability. However, in the subsequent year, there was an increase of approximately $0.93 billion, representing a 5.8% growth compared to the previous year. The profit margins also underwent changes during this period. The gross profit margin of the real estate development business narrowed to 15.2%, indicating a decrease from its unknown previous level. On the other hand, the hotel operation business maintained a consistent gross profit margin of 11.7%. The company's financial performance is a testament to its ability to generate significant positive operating cash flow. According to the provided data, the company recorded an impressive operating cash inflow of $319,119,000 in 2025. Furthermore, the net cash inflow from operating activities in 2025 was a substantial $0.821 billion. These figures demonstrate that the company is successfully converting its earnings into cash, indicating a strong and stable financial position. The company's debt level and interest expenses have undergone significant changes over the past few years. Initially, there was a notable decrease in total debt level by 19% or $24.6 billion on page 6. However, this trend was short-lived as the debt level increased by 1.4% on page 21. Furthermore, bank and other borrowings saw an increase of $4.05 million, 1.08%, on page 49, while total bank and other borrowings rose by $405 million on page 48. In terms of interest expenses, there was a substantial increase from $879,989 to $164,606, representing a 25% rise on page 14. Additionally, interest expenses increased from $147,000 to $1,328,000 on page 26. These fluctuations in debt level and interest expenses suggest that the company's financial situation is dynamic and subject to change over time. The company's performance can be analyzed through its various segments and regions. In terms of well-performing segments, property development, property investment management, and property management stood out, with significant results after changes in fair value. These segments collectively generated $4,149,292. On the other hand, manufacturing was a poorly performing segment, with losses resulting from changes in fair value. This is evident on both page 11 and page 12 of the report, where the segment results were significantly lower than others. In terms of regions, core cities such as Shenzhen and Shanghai performed well, along with mature commercial assets. These areas demonstrated strong performance, contributing to the company's overall success. Management is outlining a clear vision for the company's future direction. As stated on page 28, the company aims to transition into a leading provider of real estate asset management and urban integrated operation services by laying a solid foundation during the 15th five-year plan period. This strategic shift is further emphasized on page 33, where management highlights key areas of focus. These include strengthening investment coordination, focusing on core cities and high-quality projects, and driving technological innovation through new growth engines and business portfolio expansion. The company also aims to reshape its organization with a focus on strategic direction and talent development. In addition to these strategic initiatives, management is taking a cautious approach to inventory provisioning and making sufficient impairment provisions for equity investments, page 34. This prudent approach suggests that the company is prioritizing stability and long-term sustainability over short-term gains. Overall, management's vision for the company's future is centered around building a strong foundation for high-quality development, driving innovation, and enhancing core competitiveness to deliver stable returns to shareholders. The company has a history of paying dividends to its shareholders. According to the provided summary, there are multiple instances where dividend payments were recognized as distributions during 2023, 2024, and 2025. The withholding tax rate for these dividend payments was 5% in some cases. Notably, the company declared a final dividend for 2023, but did not declare an interim dividend for 2025. Despite this, the total amount of dividends paid out by the company is substantial, with $13,939 being mentioned on page 18. Additionally, the company received significant amounts from joint ventures and associates in both 2024 and 2025. Overall, it appears that the company has prioritized dividend payments to its shareholders over share buybacks. There are concerns about inventory buildup in the company's operations. The issue is highlighted on page 13, where a significant write-down of inventories totaling $2,405,284 HK0 was recorded. This suggests that the company has accumulated excessive inventory levels, which may be due to overproduction or inefficient supply chain management. The problem persists as evident from pages 28 and 31, where optimizing existing inventory is mentioned as a priority. Furthermore, on page 34, the company made provisions of $0.405 billion for inventory, indicating a potential loss due to unsold or obsolete stock. This trend continues on page 35, where it is stated that inventory impairment provisions increased by approximately $0.405 billion. The accumulation of inventory can lead to supply chain disruptions and inefficiencies in the company's operations. The concerns about inventory buildup are thus valid, and addressing this issue should be a priority for the company to maintain its competitiveness and profitability. That concludes the financial summary for Shenzhen Investment Limited. Feel free to comment below, and I will be happy to answer them when possible.